Do you also feel that the markets are run and manipulated by certain big players? The chart patterns show frequent false signals. It is as if the market fell only to hit your stop loss and went up right again. Hold on to that thought because you might not be the only one who thinks this way. Hello and welcome to a new video of the Polynomial Academy, a series where we will discuss the most important crypto trading and DeFi concepts. In today's video, we are going to briefly introduce you to Richard Wyckoff, one of the most prominent stock market researchers of all time, and know how his Wyckoff method might help you avoid being manipulated in the markets. But here's an important thing that you need to know first. Mr. Wyckoff gets really pissed at people who don't subscribe to this channel and press that bell icon. And why would you want to make such a great man angry, right? So make sure you do both of those things, and now we'll get started with this video. The Wyckoff method revolves around the concept of how market forces can manipulate investor psychology in their favor. In this theory, Richard Wyckoff proposed the idea of studying the markets as if a single entity controlled it. He believed that would help in understanding and analyzing the market trends better. And that's why he introduced the idea of the Composite Man to explain this technique in a better manner. The Composite Man is an imaginary person representing all of the biggest players in the market. The Composite Man always acts only in his best interest and wants to buy at the lowest possible price to then sell at the market top. Richard Wyckoff used the concept of the Composite Man to study and trade various market cycles. He realized that all market cycles usually follow 4 stages: accumulation, distribution, reaccumulation, and redistribution. Let's look at each of these stages in detail. Accumulation is the first stage of the market cycle, and it is further divided into 5 phases as per the Wyckoff method. Phase A in accumulation starts with the price finding an initial support in a strong downtrend. However, the buying pressure is not too strong and this support is eventually broken, which leads to panic selling. The price here acts like a rubber ball when you drop it on the floor. This excessive supply and panic selling is absorbed by the big buyers or the Composite Man, and the market enters a sideways trading range. Phase B is when the Composite Man accumulates his largest share of assets and the market tests the support and resistance level of the trading range. Now Phase C is the final shakeout aimed at compelling even the most resilient hodlers to sell their assets at a lower price to the Composite Man. This is the phase where most of the bear traps and false breakdowns occur. In Phase D of the accumulation stage, the price finally begins to rebound and an initial wave of optimism can be observed amongst the bullish traders. The price may correct a few times even in this phase, but it usually forms higher lows as the process continues. The accumulation stage ends with Phase E, where large buying volumes can be observed, which confirm that the price is likely to keep moving up. This is when there is widespread optimism and even euphoria in the market, leading to a full-blown bull market run. Just like accumulation, distribution stage also has 5 phases, and it begins right at the end of the accumulation stage. This means that the Phase A of distribution is actually the Phase E of the accumulation stage, where the demand starts to slow down. There's a mild selling force in the market, but the inexperienced traders consider this dip as a buying opportunity in the bull run and aggressively end up buying the market. The big sellers, like the Composite Man, absorb this excessive buying demand by distributing their holdings close to the market top. Now Phase B is the consolidation phase, where the market enters a sideways trading range and the Composite Man continues to absorb the market demand by distributing his holdings. This phase consists of repetitive testing of the upper and lower band of the trading range, which keeps the retail investors guessing the market direction. The Composite Man may seem like a Turkish ice cream seller to the retail investors in this phase, who keeps them confused throughout. Phase C is marked by some of the last bull traps and false breakouts on the chart, which give the Composite Man his final chance of selling his holdings at a higher price. The Composite Man uses FOMO, or fear of missing out here, to make retail investors buy the top while institutions try to sell. Phase D is where the price finally begins its downward trend after the Composite Man has finished distributing his holdings, and the initial doubts about the end of the bull market set into the minds of the traders. The price may bounce back a few times, even in this phase, but it usually forms lower highs in the process. Finally, the distribution phase ends with the Phase E, where the price declines sharply in a short time period and there is a widespread panic, confirming the start of a bear market. This also marks the beginning of another accumulation stage, and eventually the loop continues. I hope that you now realize that every breakout may not be genuine, and you will be better prepared for dealing with market manipulation by the big players. There's a lot more to learn if you want to avoid losing money in such market traps, and we'll ensure that you learn all of that right here on this channel. So subscribe and press the bell icon to avoid missing out, and I'll see you in the next one.